Hi, this is Craig Haskell with the Value Hound Academy. You're listening to another exclusive interview with a leading authority in the opportunistic and value real estate investing space. If you're considering a new real estate acquisition or a new development, how do you raise the equity to get your deal done? One popular option for syndicators and sponsors is to structure a joint venture with one or more equity partners. To give us some insight on the whys and hows of structuring a joint venture, we will be speaking with Bruce Kirsch, founder of REFM, a leading worldwide commercial real estate training and consulting company. Bruce teaches private investors, large company executives, and university students on how to structure and model real estate deals, especially joint venture structures. Bruce will teach you the ins and outs of using a joint venture structure to capitalize on today's distressed real estate market. In this training seminar with Bruce, you will learn the roles of a sponsor and investor, why you should be using a joint venture structure, the types of fees, cash flow, and profits a sponsor can expect, how profits are split between the sponsor and the investor, the types of sponsor and investor risks, the legal concerns of structuring a joint venture, and a 3-tier sample of how an investment waterfall can play out. If you want to get an inside look at using a joint venture to start or grow your real estate investment business, then you need to study this training seminar with Bruce Kirsch. Bruce uncovers the basics of structuring a joint venture so that you can raise bigger money for your real estate deals. Okay, so I want you to grab a pen and pad and take notes as Bruce trains us on the basics of joint venture structuring.
Okay, great. Thank you very much, Craig, for having me back. I appreciate the opportunity to give this little training piece to your group. Just a quick note on real estate financial modeling. We are a financial analysis solutions provider for commercial real estate transactions and partnership structures. And we do training. We sell Excel-based spreadsheet templates. We have a database of partnership structures that we sell subscriptions to and do consulting for some small, medium, and large-size players in the commercial real estate business. So our website is getrefm.com. That's getrefm.com. And you can see everything that we offer on our homepage. And we're happy to be able to provide tools and training to folks so they can go out and make good decisions. So today what we're going to talk a little bit about is the basics of joint venture partnership, specifically for single asset transactions. So let's say the development of an apartment building or the acquisition of a hotel. We're not going to be talking about multi-investment private equity funds. But that said, some of the principles that we will talk about do apply in that context as well. So really the first thing that I want to talk about is the rationale for partnering in the very first place. Why would one seek a partner? And then we'll talk a little bit about the legal structuring and the risks and rewards of going into a transaction with a joint venture partner. Before we get going, though, it's important to define some terms because there is no real official vocabulary for this area of commercial real estate, and people tend to use the terms that they're familiar with in the way that they know. So what we're going to do just to try to avoid any confusion is say that when we use the word principal or sponsor, those two are interchangeable, and this is the person who is going out and identifying the transaction and controlling it, or the owner of the asset. And then we'll use the name investor simply for the party that brings capital to the transaction that was found and identified and controlled by the principal or the sponsor. Okay, and so why does a sponsor typically seek a joint venture partner? Well, obviously it's primarily dealing with a need for capital, need for equity cash investment, but there are actually a lot of other benefits to the sponsor in accessing a JV partner. One is better access to lenders. Okay, equity is only part of the equation, and it's actually the minority part of the equation. So to the extent that a investor can help to open doors with lenders to that sponsor that they otherwise would not be able to get into, that's a huge positive for the sponsor. Second is credibility. Credibility, especially in today's market, is so vital to being able to pursue and do the transactions that you really want to do. You need brokers and sellers to believe that you will actually go in and arrive at the closing table and close at the terms that you said that you would. And this is really critical. And so if you have an investor that perhaps has a very long and positive track record in a particular market, and you're affiliated with them, it can only help you. So that credibility is another benefit to taking on a joint venture partner. Another one is if the investor has a lot of investments, they might have some preferred providers with respect to real estate services, let's say maintenance or security or janitorial. If they're involved with a lot of buildings in that city, they probably have access to some preferred pricing with respect to those operating elements. And so no sponsor in their right mind is going to turn down the ability to save any amount of money because every penny saved on the operating side is a penny that drops to the bottom line for net operating income. And lastly, and importantly, is the investor partner is going to bring strategic and technical expertise. And this can be extremely beneficial if the sponsor is entering a new submarket or a new asset type, or the transaction is particularly complex. To have somebody who's not entirely emotionally attached to the transaction and has the ability to look at it in an objective manner and apply some of their experience on the technical side and strategically is terrific. It's a great benefit as well. So that's from the sponsor's point of view. The investor, you can look at it in a little bit more of a cold and calculating way. The investor is looking for, how do I rub two dimes together and get a quarter? They're looking for an investment vehicle. Okay, and capital chases performance, and so they're looking for opportunities to deploy their capital over a time horizon that works for them in amounts and at the scale that works for them on certain terms into either real estate development or the acquisition of existing income-producing properties or perhaps into mortgage notes. And so investors really are, they're looking for vehicles. And the sponsors, naturally, are providing opportunities in the form of potential transactions, whether they be developments or acquisitions or note purchases. On the legal side, single transactions are almost always going to be set up as a single or special purpose entity. That takes the form of a limited liability company or LLC. There's lots of benefits to using the LLC vehicle. It's easy and inexpensive to form. It allows for multiple owners and, importantly, allows the pass-through of taxes to the straight to the individual, so that you don't have to deal with double taxation. For a fund that is going to pursue and execute on multiple transactions, those are typically going to be set up as a limited partnership or LP, wherein the fund members, the sponsor, is going to serve as general partner or the managing member, the GP, and the investors, of which there will likely be multiple parties, will serve as the LPs or limited partners. And so one way that I like to discuss joint venture partnerships is to draw an analogy to say a joint venture partnership is really like a journey to a uncharted destination, that if you reach it there, let's say it's a plane journey, if you reach it there successfully, there will be some significant financial reward, okay? And so the question is, well, who's the pilot of the plane? Who's securing the ability to fly the plane? Who's fueling the plane? And so on. And so using this analogy, we need to understand first that everyone here is going to be enabling the transaction in some way. All of the parties are necessary. You have to have a plane, you have to have a pilot, and so on. So no one is sufficient by themselves. Okay? So the sponsor is going to provide the transaction sourcing, which we can liken to identifying this destination. They're going to provide some capital, although it's a minority share. It's going to help to secure the right to fly the plane, and the day-to-day execution, which is the most important piece here, the safe piloting, and of equal importance, the safe landing of the plane. The investor is going to provide the majority of the capital, and we can liken that to leasing the aircraft and providing the fuel. And they will also help to provide the air traffic control function by giving periodic strategic input to help keep the plane on course and avoid and mitigate risks to the extent possible. And so everyone here is doing some work, and the question then becomes, well, who's doing more work and presumably adding more value? And is there a one-to-one tie between the number of hours that somebody is spending on the transaction and the amount of value that they are in fact creating? And so if we look at it from the sponsor's perspective, the sponsor has allocated overhead, which is significant to them, to find and secure the transaction. They've taken entitlement risk if it is a development transaction, and they will also commit to performing the day-to-day execution. They're going to be making thousands of decisions, okay, spending tens of thousands of person hours over multiple years. So this is a tremendous endeavor and significant undertaking and dedication of resources from the sponsor's side. On the investor's side, they're primarily the capital provider, and so you can look at it in a little bit of a cynical way and say, well, they really only had to make one decision, and that decision was, should I invest or not invest? And once that's done, then they're simply providing capital upon capital calls. However, as we noted, they are adding value in the form of providing strategic input. And so this can be very valuable, but it's not going to amount to the tens of thousands of person hours. Maybe this is hundreds of person hours over several years' time. Okay, so that's the work. What about risks? What risks are each side taking, and in what proportion? The sponsor's taking a significant financial risk to them. One thing that's important to understand with respect to the sponsor is the capital that they are claiming they are putting in, is it really their capital, or is it perhaps coming from some other source? And so this can change motivations a little bit if it's not, in fact, their capital. So it's an important question to ask and to understand as the investor. The sponsor might also be providing personal recourse guarantees to the lenders, either partial or full, and this is where they would be required to pledge personal assets as collateral against the loan. For example, providing a guarantee for an acquisition loan. And this naturally is a big risk and an exposure, and can provide a lot of sleepless nights to the sponsor if things don't go according to plan. And so this is serious. And generally speaking, the investors will not have to subject themselves to these things, although there is no one way that these structures are put together and one way that banks are going to structure the guarantees. Sometimes it is, in fact, pro rata, the guarantee between the sponsor's contribution and the investor's contribution. And lastly, the sponsor is going to be taking significant reputational risk because it's going to be their name that's out there on the billboard at the construction site and their name in the local papers and so on. And one of the things about real estate development and playing in the real estate game in general is that it's an extremely public endeavor. And so you can either be the hero or the villain in a very public way, whether or not you wish to be out there in the public domain. What about the investor? What risks are they taking and in what proportion? Significant financial risk. Sometimes, as I said, they will also be exposed to recourse, such as pro rata to the sponsor. And they do have some marginal reputational risk, although most people don't really know who the capital provider is on a transaction. They know and are aware of who the local player is because that's the person whose name they see on the billboard and so on. With respect to the types of financial risk, just a little bit more detail here. On the sponsor side and the investor side, there are front-end acquisition and development funds, and these are the riskiest types of funds, are those that are related to pursuit of a transaction. These are dollars that will never come back if the transaction is not consummated. There's no value in them for the time that you spent speaking with a zoning attorney about a particular site or running an environmental test on a site that you end up not closing on. And so those risky dollars, generally speaking, are coming primarily from the sponsor. The second is, if it is a development project or there's a construction element, who is going to bear construction budget shortfalls? Are these going to be shared on a pro rata basis? And what about operating deficits? Are those going to be shared on a pro rata basis? There's lots of types of financial risk, and we spoke about the recourse guarantees already. And so, given all of these elements, the roles that the sponsor and the investor play, and the financial risks that they're taking, and the other risks that they're taking, and the hours that they're committing, the next question becomes, in what proportion are the sponsor and investors seeking to be rewarded for the various risks that they bear and the roles that they're playing? And so, really what that question boils down to, was it has to, at the end of the day, boil down to dollars, is how can the splits of the cash flows that come from the transaction be commensurate with both the risk taken and the value added? And so this is the question that everybody wants to know. Well, unfortunately, there is no one structure. There's no typical way to do it. These types of profit sharing and joint venture structures vary across property type, geography, submarket, transaction type, and naturally across all of the different personalities and individuals that are members of thousands or tens of thousands or hundreds of thousands of real estate partnerships that are active at any one time. The structure is going to end up being totally negotiation specific, and then everything will be negotiated down to the finest point. Nonetheless, they are going to all of these negotiations are all going to revolve around the end goal, which is for the transaction to reach its potential by navigating through treacherous waters and mitigating risks, both the ones that we know about and the ones that we don't yet know about. And so in order to achieve the goal, we need two things. We need top performance by the sponsor, and we need sound input from the investor. And so the question becomes, well, how do you get top performance from the sponsor? How do you properly incentivize them? So let's take an example here. Let's say that the sponsor puts in 10% of the capital and the investor the balance, 90%. And let's say that the way the transaction is structured, the sponsor will only get, no matter how well the transaction performs, only get 10% of the profits. Okay? Well, if I'm the sponsor and I'm involved in a transaction that's set up in that way, and then I'm also, at the same time, involved in a transaction where if I do particularly well with the transaction, I might get something above and beyond the 10% share that I contributed in cash. Which one of those two do you think that I'm going to pay more close attention to? Well, it's just human nature that you're going to probably, on the margin, spend a little bit more time and energy and be a little bit more careful with the one where you have more potential upside, more potential financial reward. And so really when we take a look at these two pie charts where it's 90-10 in and then 90-10 out, while we might think at first blush that the third-party investor would want to, in fact, take 90% of the profits, it's not in their best interest because, as we said, the sponsor is piloting the plane. So we want the pilot of our plane to be alert and awake and motivated to make this the safest and the most successful journey possible. And so what we see is, what we're going to do is give the sponsor proportionally more back in terms of financial reward than they contributed. And what we have as a result is that the total net cash flow will be weighted disproportionately in favor of the sponsor. And so the question becomes, well, are there any other potential benefits to that? And the answer is yes. The answer is, well, if they are going to be trying that much harder, they might not only get 30%, but they might create a bigger pie for everybody. And so everybody's going to win bigger. And so this is really the best alignment mechanism that we know of that is used in a very widespread manner as a result. And so the question now becomes, well, how do you affect this disproportionate reward to the sponsor, something larger than the 10% share of cash that they put in to come back to them as financial reward? And there's two ways to do it. One is through fees that are related to the transaction. So as we said, the sponsor can be thought of as the pilot, and so they would be the player who is in charge of making all of these hundreds or thousands or tens of thousands of decisions over the course of the transaction. So if it's a development transaction, they would be the one who would benefit from the development fee. If it's an acquisition, they would get an acquisition fee. And then once you have an asset, they would be the ones to benefit from leasing fees or property management fees or asset management fees, and perhaps also a fee at sale based on the sale price that is achieved. So that's the first way. The second way, which is the way that provides typically the bulk of the additional financial upside, is to give the sponsor a carried interest or a promote in the transaction's cash flow separate from the payout of these fees. And so there's two ways to do this. You can do it in a simple way where you will have a single cash flow split mechanism, such as, let's say it went in 90-10. After a payment of a preferred return and the return of the invested capital, it would then be split, the residual excess cash flows would then be split 50-50. Okay? So that's just a single split mechanism. The alternative is to do a complex, multiple tier split mechanism that is known as an investment waterfall. And so what we have with these investment waterfalls is a sliding scale. We have a sliding scale that will shift the share of cash flows more and more in favor of the sponsor, the better that the transaction performs. So if we were to define successively higher levels of transaction performance as Tier 1, and then Tier 2 is an even better performance, and Tier 3 is the highest level of performance. At Tier 1, it might be a 90-10 split, but at Tier 2, the investor would forfeit 10% of the cash flows that they would otherwise receive if they were to get 90, and give that 10% to the sponsor so that the split at Tier 2 is 80-20 as opposed to 90-10. And then, as an example, finally in Tier 3, the investor would forfeit not only 10% but an additional 30%, so they would forfeit in total 50% of their fees from the 90, and the final split at Tier 3 might be a 60% to the sponsor and 40% to the investor. So what we see is a switching of who ends up getting the majority share of the cash flows should the transaction in fact reach that highest level of performance. Okay, and so this all makes good sense, but it's a little bit tricky, unfortunately, mathematically, to figure out, well, which dollars are in the Tier 1 bucket, which dollars belong to Tier 2, and which dollars belong to Tier 3. Okay, and so what we essentially need to come to understand is how do we isolate cash flows such that we know which amounts to split up 90-10, which amounts to split up 80-20, and which amounts to split up 60-40. And so one of the ways that this is performed is through a internal rate of return hurdle mechanism. And so let's say that the first hurdle might be 0% IRR through a 10% IRR, and the second might be all performance that relates above a 10% IRR through a 15% IRR, and then the last would be all cash flows that apply to performance above a 15% IRR. Okay? And so what we do is we do the math that will target these dollar amounts that would apply to these levels of performance, and then measure the actual dollars that come out of the transaction and compare them to the targeted dollar amounts, and then split things up as appropriate. And so this requires a few steps, but it is all doable, and these are the types of things that we address in detail and that everybody gets to do hands-on work with in our monthly webinars on the joint venture partnership and waterfall modeling. And so this is a series that we run every month. For this month, which is August 2012, we are holding the two-day event on Wednesday, August 22nd for 2 hours, and the second half for 2 hours on Thursday, August 23rd. And as I said, this is a monthly thing, so we find that they really enjoy this webinar because it takes a very slippery concept and makes it accessible, and people always leave feeling like, they've been enlightened to a certain extent, and they feel empowered.
I hope you enjoyed this interview. For more information on Bruce Kirsch and REFM, visit their website at www.getrefm.com or email Bruce directly at bkirsch@getrefm.com. Also, to get more information on Bruce's upcoming webinar on joint venture structuring and waterfall modeling, please click the link on this page. For any other questions, comments, or ideas, please email me at craig@valuehoundacademy.com.